Europe thought it had found the perfect weapon. In March 2024, European governments seized $15 billion in Russian assets and redirected the money to Ukraine. No new taxes, no painful votes, no domestic backlash. Just take the money. For about 2 weeks, it looked brilliant. Then Russia responded, not with angry speeches or emergency UN meetings, but with something far more devastating. Russia nationalized more than $120 billion in European corporate assets. Volkswagen was gone. Shell was gone. Siemens was gone. 30 years of European investment erased almost overnight. And then came the twist no one in Brussels was watching for. China bought everything. To understand how this happened, you have to go back to early 2024. The war in Ukraine had entered its third grinding year. Ukraine was burning through cash. European voters were exhausted from endless support packages, and governments were under growing political pressure. Budgets were tight, and patience was thinner than ever. Then someone asked a question that sounded obvious. Russia has over $100 billion sitting in our banks. Why not take it? These weren't factories or oil fields Russia could defend. They were central bank reserves and sovereign investment funds sitting quietly in Frankfurt, Paris, and London. Freezing assets during conflict is normal. Sanctions do that all the time. But actually confiscating sovereign reserves and transferring them to another country was something else entirely. It had never been done by a major economy on this scale. European lawyers worked overtime. Creative legal theories were built. Small precedents were stretched. And in March 2024, the announcement came. European leaders called it innovative economic statecraft. Financial media praised the boldness. Ukraine celebrated. The story was simple and elegant. Russia would pay for its own war with money it couldn't defend. For 2 weeks, it looked like a master stroke. What European leaders failed to ask was a far more important question. What can Russia take from us? Russia had about $105 billion in Europe. But European companies had spent 3 decades investing inside Russia. Factories, energy projects, rail systems, supply chains, entire industrial ecosystems. The math was never close. Moscow's response was swift and calculated. Russia announced the permanent nationalization of all European corporate assets on Russian territory. Not temporary seizures, not suspended operations. Permanent nationalization. The total value exceeded $120 billion, more than Europe had taken. Volkswagen had been operating in Russia since the 1990s. They had built factories, trained workforces, developed supply chains, and in some cities their plants were the largest employers. The Russian state took the factories, the equipment, the intellectual property, and the brand rights. Volkswagen's Russian subsidiary simply ceased to exist as a German company. Siemens lost decades of power infrastructure, rail systems, maintenance contracts, spare parts, and technical documentation. Shell lost massive energy stakes in projects like Sakhalin II and Arctic LNG, joint ventures worth tens of billions. Russia nationalized every foreign share. Shell received not a single ruble in compensation. And it wasn't just the giants. Danone lost dairy plants, Carlsberg lost breweries, Auchan lost retail chains, Renault lost automotive factories. Hundreds of European firms woke up to find that everything they had built over 30 years now belonged to someone else. The immediate losses were staggering, but the real damage came next, because Russia didn't keep those assets. They sold them, at deep discounts, to Chinese companies. Think about what that means. European firms had spent decades building market share in Russia, learning local customers, creating distribution networks, training workers, and earning consumer trust. That kind of competitive advantage can't be rebuilt quickly. Russia handed it to China in months. Volkswagen's market share didn't disappear. It transferred to Chinese automakers who bought the factories and kept producing with the same workers, the same supply chains, and the same customers, just under new brands. Shell's energy projects didn't stop. They continued under Chinese ownership. Europe lost 30 years of investment. China gained it almost overnight. Russia's retaliation didn't stop there. The second move was quieter but far more dangerous over time. Russia announced that all energy and commodity exports would be settled only in rubles or yuan, no euros. Europe assumed this would isolate Russia. It didn't. India created rupee-ruble payment mechanisms. China expanded yuan settlement. Turkey built bilateral systems. Within months, much of Russia's trade bypassed the euro entirely. Sanctions that depended on euro-based leverage lost much of their power. The signal to the world was unmistakable. The Western financial system was no longer mandatory, it was optional. Then came the move that truly alarmed European central bankers. Russia, together with its BRICS partners, announced a $150 billion BRICS Plus reserve fund explicitly designed to be seizure-proof. Central banks hold reserves for stability and crisis response, and traditionally those reserves are held in dollars and euros inside Western institutions, which means they can be frozen, seized, or confiscated. Russia demonstrated that risk was real. For any country watching, the lesson was chilling. Your reserves are only yours until a Western government decides otherwise. Within weeks, countries quietly began asking questions. Saudi Arabia paid attention, not because it is anti-Western, but because it holds around $600 billion in reserves. If it can happen to Russia, why not to them? Europe lost over $120 billion in corporate assets. Russia lost $15 billion in reserves. But China won everything. Market access, industrial infrastructure, energy equity, trained workforces, currency influence, and financial leverage, all without firing a shot. The damage didn't end there. Reserve managers don't panic sell euros. They adjust quietly. As bonds mature, they reinvest less in euros and more in gold, yuan, or alternatives. Multiply that behavior across dozens of countries, and European bond auctions become less oversubscribed. Borrowing costs increase, growth slows. Even small shifts translate into billions in additional interest costs over time. At the same time, the financial infrastructure itself is changing. SWIFT was once untouchable. Russia's SPFS and China's CIPS now handle most of their bilateral trade. By late 2024, more than 60% of Russian trade bypassed SWIFT entirely. Turkish banks, Indian banks, Central Asian and Middle Eastern institutions began connecting. Every connection reduced dependence on Western-controlled systems. Reserve currency status is not built on interest rates. It is built on trust. Privately, some European policymakers now admit the seizure was a mistake. Publicly, they cannot. The precedent cannot be undone. The assets are gone. The lessons are harsh. Financial weapons are double-edged. When you weaponize the system, you damage the system itself. Always calculate retaliation, not just whether you can act, but what the other side can take in return. For 70 years, Europe's financial credibility rested on a single promise: protected by law, institutions, and predictable rules. That promise has been broken.